Hey everybody, it's Larry Berman here. What a crazy week of volatility on the AI stage, on the earnings stage, on the Trump stage. I spent better part of this week at the Alternatives Miami conference down in South Beach, and we dug deep on private equity and private credit and all kinds of alternative investments. And I got to tell you, with valuations the way they are today, with corporate spreads as tight as they are in the public markets, and multiples as high as they are in the equity markets, the private markets for me continue to be a great source of opportunity for the next couple of years, and where I'm highly recommending investors allocate money to. Challenge there, of course, is access. Okay, let's dig into the chart room and see what we learned this week. So we learned that the Canadian economy, from a GDP perspective, way back, is firing on one cylinder and one cylinder only. When that report printed, the Canadian dollar started to soften. But in addition to that, and the Bank of Canada's rate cut this week, and the Fed not cutting rates, the path of the Canadian dollar continues to be weak, but really on the go forward, February 1st was set as tariff day from Tariff Man. When we look into the Canadian dollar here, we see in the last couple of days, a spike above 145. We closed above 145. When we've looked at this long-term chart, and I'm just going to max this out going back to the early 1970s, we talked about this is scary, but it's temporary. And when you think about the next 1 year, 3 years, 5 years, 10 years, this is the place where you want to be hedged on your currency, notwithstanding that we could go to 150 or 160 if Trump goes completely overboard and our lame duck government here in Canada doesn't have well, I think Mark Carney's going to be the leader of the Liberal Party of Canada and will be the next prime minister. And we'll see whether the election is right, as they come back to Parliament on a non-confidence vote, or are they able to pass a budget with the support of the NDP and sort of have an October election as was widely thought of before Trudeau's departure recently. So we'll see how all that plays out. But from the perspective of Canada and the Canadian dollar, it's at a low point right now. Buying assets in the US make that even worse. So, private markets, really attractive to me here. Okay, so, the market bounced back this week from the volatility on the DeepSeek shock that we saw on Monday. We talked about that on Berman's call. We said it was likely the beginning and the continuation of a high volatility period, and tariffs are a big part of that. So around 120 today, there was a headline that printed at 120. You can see it there. White House says Canada, Mexico, China tariffs to start February 1st. A few minutes later, 25%. So, okay, we'll get some more details on that. But as the day progressed and as the headlines came out here, later in the day, Trump says steel, aluminum this month or next. So, he's playing this hedge, not hedge, all in, not all in. That's just his style. We should be used to that. So what does that all mean? It means, okay, here's where we are on TLT long treasuries. Markets trading flat to up on the day. Headlines come out here at 120 and bond yields start to spike up. Price down in TLT because tariffs inflationary, bad for the long end of the curve. And then a few minutes before the end of the day, he goes, whoa, some now, some later. And, bond market, sort of ramps into the 4 o'clock close. Absolutely insanity. But my point was, whether it's AI, tariffs, or whatever, get used to a lot of these swings and volatility. For the traders out there, this is a good opportunity to trade. On the equity side, again, there's 120 headlines hit. Stock market was grinding higher. testing and potentially breaking out to new all-time highs. Headline hits, big reversal pattern. So what does that all mean on the charts? Here we are. So Tariff Man gets elected. Animal spirits, big gap. A couple weeks back, we tested the election gap. We talked about that being very important support. We got the reversal. We suggested a move back to the high was likely. A couple days here looks like it's going to break out. Earlier in the week, we get the AI DeepSeek gap. Markets has a gulp, tests a moderate moving average in the 50-day here, bounces off that, can't make a new high, reversal pattern. So what's going to happen this week? Well, what I can promise you is more volatility is coming. Don't necessarily know in what direction. So what we get this week is the quarterly refunding announcement. So Scott Bessent, new Treasury Secretary, all the damage that Yellen did playing and using the Treasury to try to improve economic conditions, keep her job perhaps. Scott Bessent, as a hedge fund manager, very outspoken against those policies. If we're to normalize the way Treasury historically has financed things, it's going to take several years, but it means more duration. It means more coupons being issued. There's a lot of tax money coming in, given last year was a great year for the stock market. So in the short run, there's not going to be a lot of pressure on the bond market. Extend that out later this year, next year, the next year, depending on what Trump spends or not, depending on how much Doge can save the US taxpayer in terms of expenditures. The story is really not that much. Again, you've got the catalyst here for these markets to swing both ways. If you look at term premium on bonds and the US 10-year, 4.75 to 5%, and the long bond at 5 to 5.25. I love them there. I'm buying them all day there in terms of putting on risk. What that should mean for equities is a 2-point multiple hit. So when you look at the S&P 500, what is a multiple point hit? Well, that is the multiple of earnings. So if earnings are going to be $263 for the next year, that's the estimate, the trailing 236. So if we're going to get 11% earnings growth this year, and let's say we don't get that. Let's say it's more moderate than that. Let's say it's 250, 2 multiple points on the S&P, 500 points. We're talking about a normal backing and filling correction from 6,000. We're not talking about we're going to wipe things out here. Now, if they don't fix the way they're funding and they continue to stimulate, inflation comes back, the Fed has to start raising rates, and oh boy, is that a bad outcome. So we'll see how it all goes this week with the Treasury funding announcement. We don't expect really any shocks at 8:30 a.m. on the 5th when we get the details. We get at 3 p.m. on Monday the 3rd, when Berman's call is live, we get the total numbers, but we don't get the makeup of that number until Wednesday morning. And that should be a bit market moving, but we're not expecting any dramatic surprises. This one being the Treasury's, new Secretary Treasury's first meeting, likely be status quo for now. More to worry about on the bond side as we go forward in the back half of the year. Anyways, that's all I got this week. More volatility ahead. Govern yourself accordingly.